Hello and welcome to CN Professional Institute. We are still on IAS 16 PPE. In the previous video, we solved some questions, right? We solved some practical questions. Now, let's continue from question 4, right? We solved some questions already, and let's continue from question 4. Question 4. On 1st January 2023, the fair value of CCN's property was 400,000 with a remaining life of 20 years. The company's policy is to revalue its property at each year end. At 31st December 2023, property was revalued at 340,000. The balance on the revalued surplus account at 1st January 2023 was 80,000, which relates entirely to the property. CCN does not make transfer to realize profit in respect of excess depreciation. Required. I prepare extract of CCN's financial statement for the years ended 31st December 2023 and 31st December 2024, reflecting the above information. II. Show how the accounting will be different if the opening revaluation surplus did not exist. All right, so let's solve this question. Question 4. Here we were told that CCN does not make transfer. All right, so I explained the transfers to you. Here we were told that CCN does not make a transfer. All right, we'll look at the subsequent questions where we have transfers and then we'll learn how to go about them. But here we're told they do not make what? Transfers, right? Okay. So we start 1st January 2023. Okay. The property was, the fair value was 400,000 with a remaining life of what? 20 years. And when the revaluation happened, it happened on 31st December 2023. So this is just a year what? It was just a year from 1st January 2023 to 31st December 2023. So just 1 year. 1st January 2023 to 31st December 2023. So let's charge depreciation. And depreciation will be equal to 400,000 divided by 20 years. And it's 1 year, so times 1. And this gives us what? 20,000. Right? So 20,000 is the accumulated depreciation, or let me say depreciation for that year. Then carrying value as at 31st December 2023 will be equal to the 400,000, okay, minus what? 20,000. And that gives us what? 380,000. So 380,000 is the current value as at the date that we are doing what? The revaluation. So we have the current value. Let's compare with the revalued amount. So the revalued amount is equal to, in the question is here, 344,000. Okay, so that's the revalued amount. So when you compare the revalued amount to the current value, you see there's a revaluation loss. Why do we have revaluation loss? The current value is more than the revalued amount, or the revalued amount is less than what? The current value. So there's a revaluation loss. Okay, which is the 380,000 minus 344,000. All right, and this gives us 36,000. So 36,000 is the revaluation loss. All right. So with this revaluation loss, what do you do? If you want the entry, then you have to debit your revaluation surplus account. Okay. With what? The 36,000. Now, why are we debiting revaluation surplus account? You realize that there is a balance in the revaluation surplus account. So because of that, we are recording the loss in the revaluation surplus account. If there's no balance, we wouldn't have recorded the loss in the revaluation surplus account. We would have recorded it in what? Profit or loss. So we debit value surplus account and we credit PPE with what? 36,000. All right. So this is the entry. All right. So don't forget, we have a loss of 36,000. And I'm saying this revaluation loss will be recorded in what? The revaluation surplus account. Because we have a balance here of what? 80,000. Okay. Sitting inside the revaluation surplus account, sitting in the revaluation surplus account. So this loss should also be taken to the revaluation surplus account to go and reduce the what? The balance. All right. Let's not forget that we'll go and reduce the balance. Okay. So this loss here will not be taken to P&L, but rather we'll take it to the revaluation surplus account. All right. To go and reduce the balance. If there's no balance, then we'll record it in what? Profit or loss. So this is the entry. Now let's prepare some small extract. So we are still working on the I. Let's look at the extract. So let's look at the extract. We are going to record depreciation of 20,000, and that depreciation is for the year. Then let me put this in brackets to show it's an expense. I told you can equally leave it. Then we go to OCI, other comprehensive income. We have revaluation loss of 36,000. Let me also put that in bracket. Then when you go to the statement of financial position, so in the statement of financial position, okay, the PPE, which is non-current assets, okay, will be valued at the closing valued amount 344,000. Okay, and then we have the equity. So this is the asset side. If you go to the equity side, okay, in the equity side, we have revaluation surplus account. And as I told you, all right, revaluation surplus account houses balances. So it is not the 36,000 loss that you are going to record in the revaluation surplus account. Okay, it's the balance. So we have, or we had 80,000 sitting in the revaluation surplus account, and we made a loss of 36,000, and we said we use that loss to reduce the balance. We use that loss to reduce the revaluation what gain, or we use that loss to reduce the balance in the revaluation surplus account, right? So we are going to have 80,000 minus 36,000, and that will give us what? 44,000. All right. So 44,000 will be the balance left in the revaluation surplus account. Don't forget that if you make loss, because we have balance in the revaluation surplus account, we have to take the loss to the revaluation surplus account to go and reduce it. So we debited the revaluation surplus account and we credited PP to also reduce the PP balance. All right. Okay. So don't forget this principle. Let's look at the II. So II is saying that, okay, we should show the account, we should show how the accounting will be different if the opening revaluation surplus did not exist. So if we have no opening value surplus, then the whole 36,000 loss will be recorded in what? Profit or loss. So don't forget that if we don't have opening revaluation surplus, then the 36,000 loss will be recorded in profit or loss. So in that case, we will debit profit or loss with what? The 36,000, and then we'll credit PPE with what? 36,000. All right. So this is how it's going to be. So the loss of 36,000 will be recorded in profit or loss, and the current value will still be 30. Will still be 344,000. That's 344,000. So that's it. If there's no balance in the revaluation surplus account, then the loss will be recorded in P&L. It will be debited to P&L. Okay. But if there's balance in the revaluation surplus account, then we'll record the loss in the revaluation surplus account. All right. Question 5. So question 5. CN purchased a property costing 3 million on 1st January 2022 with a useful economic life of 10 years. It has no residual value. At 31st December 2022, the property was revalued at 3,240,000, resulting in a revaluation gain, or resulting in revaluation being recorded in other comprehensive income of 540,000. There was no change in its useful life. CN makes a transfer to realize profit in respect of excess depreciation on revalued asset. On 31st December 2024, the property was sold for 3,600,000 Ghana cedis. Required. Explain and illustrate how the disposal on the property should be accounted for and how the previously revalued assets should be treated in the financial statement for the relevant years. Now, this question is a bit complex. It's a bit complex, but it's not complex. Now let's solve it. Here we are blending revaluation with transfers with disposal. We are blending the three. All right. But we'll do it. It's not difficult. Now the rule is clear. We said that with the transfers, sometimes if you revalue your asset upward, it increases what the revalued amount. Okay, so if you revalue your asset upward, the revalued amount increases, and then subsequent depreciation will also increase. All right, and therefore we said if depreciation increases, profit will reduce. Okay, and retained earnings will also reduce. So what we do is that because revaluation will reduce our profit and will also reduce retained earnings, we take a portion from the revaluation surplus account to what, to retain earnings, to go and make up for the shortfall in profit, to make up for the shortfall in profit as a result of revaluation. So that's a transfer. So what we do is that we compare depreciation without revaluation and depreciation with revaluation. We compare depreciation without revaluation and depreciation with revaluation, and the difference is the excess depreciation, and that's what we are going to transfer from the revaluation surplus account to what, to retained earnings. So that's it. What we transfer is the excess depreciation. Compare depreciation without revaluation and depreciation with revaluation. The difference is what we are going to transfer from revaluation surplus account to retained earnings. So let's start here. So 2022. So let's start with year 2022. Okay. Now here the asset was purchased on 1st January. Okay. And the revaluation happened on 31st December. Okay. So it's only a year. So depreciation will be equal to the 3 million over the life of the asset, which is what? 10 years. It is clearly stated up here. So 10. And that'll give us what? 300,000. So carrying value as at 31st December 2022 will be the 3 million minus the 300,000. And that will give us what? 2,700,000. So 2,700,000 is the carrying value. Then you compare with the revalued amount. The revalued amount is in a question. It was revalued at 3 million. So that's 3,240,000. So 3,240,000. And you see that the revalued amount is more than the carrying value. So this will give us a revaluation gain. What's the difference? The difference is 540,000. That's the 3,240,000 minus the 2,700,000. It's 540. And that's what we've been given the question. They said it led to what? Revaluation gain of 540,000. Are you following? So we got the same revaluation gain. Then, so this is 2022. This is what will happen in 2022, right? Then let's continue. So let's go to 2023. So if you go to 2023, now in 2023, nothing, they didn't say anything, but they said the property was sold in 2024. So it means you have to charge the for 2023. Okay. And get the carrying value. And then also move on to 2024. Okay. Do the same before we can work on the disposal. So 2023, your depreciation, okay, will be the revalued amount 240,000 sorry, it will be 3,240,000. That's the revalued amount. So we said after revaluation, okay, and you are charging depreciation, we charge depreciation on the new revalued amount, not the old carrying value or not the old cost. When you are done with revaluation and you want to charge depreciation now, we charge depreciation on the revalued amount. So for 2023, our depreciation will be what? On the 3,240,000 over the remaining life. Now the remaining life is now what? 9 years. Don't forget that. It was 10 years. Charge depreciation for 1 year in 2022. Okay. So this will give us 360,000. So you see that this depreciation, okay, is depreciation after the revaluation. So this is depreciation after what? Revaluation. Now, let's do something here. Okay, even before that, let's get the carrying value first. Okay, don't worry, let's get the carrying value. So carrying value as at the end of 2023 will be the 3240 minus the 360, and that'll be equal to 2880,123. Right, so this will be the carrying value as at 31st December 2023. It's just the cost, which is now the new revalued amount, minus the subsequent depreciation, which is the 360, and that gives us 2880,000. Now let's look at something. We said that the question said the CN makes a transfer to realized profit, and we said to get that transfer from realized profit or transfer to realized profit, we compare the depreciation without revaluation and depreciation with revaluation. So you see, check this here. Without revaluation, we're charging depreciation of how much? 300,000. We're charging depreciation of what? 300,000 here. Are you following? But with the revaluation, look at the depreciation that we're charging now, 360. You get it? We are not charging 360,000. Without the revaluation, we're charging 300 depreciation, 300,000 Ghana cedi depreciation. But now after the revaluation, we are now charging 360,000. So you see, the excess. So what will be the excess? So the excess I told you is the difference between what? Depreciation after revaluation, or depreciation with revaluation, and depreciation without revaluation. So that's the 360,000 minus what? The 300,000. Are you following? And that's what? 60,000. So this 60,000 is the excess depreciation as a result of what? The revaluation. And this is what we are going to transfer from the revaluation surplus account to retained earnings. This is the excess depreciation, and this is what we are going to transfer from the revaluation surplus account to retained earnings. So if that's the case, then what do? You debit the revaluation surplus account with what? 60,000, and then we'll credit retained earnings with what? 60,000. That's all. So we are debiting revaluation surplus account, and we are crediting retained earnings. Now, if you debit revaluation surplus account, you are transferring because it has a credit balance. So if you debit it, you are subtracting, and the retained earnings too has a credit balance. So if you credit it, you are adding. That's how you'll be. Then this 2023. Now let's go 2024 when the asset was sold. So 20, let me change my pen color. 2024. 2024 too, we have to continue to depreciate the asset because the sale happened. The property was sold, okay, on 31st December 2024. So we have to depreciate for 2024. So 2024, our depreciation will be the carrying value from 2023, which is what? The 2,880,000 divided now, the life is now 8 years because as at 2023 it was 9 years. As at 2024 it will now be what? 8 years, right? You got the same depreciation for 2023. So 2,880,000 divided by 8, and this will still give us the same 360. Okay, so if you like, you can bring the same depreciation for 2023 here. So that's it. And here too, you realize that here too there will still be excess depreciation. Don't forget that. All right, there will still be the excess because here too the depreciation is 360, but without valuation it would have been 300. Okay, so carrying value as at 31st December 2024 will be 2880,123 minus 360,000. Okay, and that will give us 252,0123. So this is the current value as at 31st December 2024, and this is what we are going to record, or this is what we are going to compare the proceed with, because they still happen on 31st December 2024. So as 31st December 2024, this is the current value. So this is what we are going to compare the this is what we are going to compare the proceed with to determine whether there's gain or loss on disposal. Don't forget that if you want to get loss or gain on disposal, you compare the current value with the proceed. You have the current value, you compare with the proceed. But don't forget that to here there's the same excess depreciation again of what? The 60,000. Because again, had it not been the revaluation, the depreciation would have been what, the 300,000 from the beginning. That's from from 2022. Okay, but with the revaluation, the with the revaluation, okay, the depreciation is still, or it's now what, 360. So there's also 60 excess depreciation, which is the same as the excess depreciation in what, 2020 what 3, and it is annual. Okay, the transfer is annual. That's what the standard says. Somebody might say, why don't you do only one transfer for only 2023? Okay, why don't you transfer only the 60 in 6,000 2023 and 2024? We don't do any transfers. It's annual. The transfer is annual transfers. Okay, all right. So yeah, so let's now compare the current value with the proceed and see if there's loss or gain on disposal. So here the proceed is 3,600, sorry, 3,600,000 Ghana cedis, 3,600,000, and the current value is 2,520,000. All right, so here we realize that we have a gain of what, 1,080,000 Ghana cedis. Okay, so we have a gain on disposal, which is what, 1,080,000. Okay, so this gain will be recorded in what, profit or loss. So we said gain on disposal, we don't care whether we have previously revalued the asset or not. Gain on disposal is recorded in profit or loss. And we also said that, okay, if there's still a balance in the revaluation plus account and the asset is sold, don't forget the second transfer. We said the entity can transfer the balance in the revaluation plus account to retain earnings, or the entity can leave it there. We also learned this is the second transfer we talked about. Okay, the first one is the excess depreciation, and the second one is when the asset is sold and then there's still balance in the revaluation plus account, the entity can decide to transfer that balance to retain earnings or leave it in the revaluation plus account. Now let's go and do some extract. So let's play the extract. Let's start with the POL. Now we have 3 years, so 2022, 2023, and 2024. So depreciation, 2022 is 300,000, 2023 is 360,000, 2024 is what, 360,000. So you can put this in brackets, okay, to choose an expense. I took this an extract, so no fight over this. Okay, so with the OCI, we have revaluation gain. All right. Okay, so we have revaluation gain for 2022. we have 540,000. 2023, there's no gain. 2024, there's no gain. All right. Then let's go to statement of financial position. So with the statement of financial position, okay, 2022, 2023, and 2024. So we start with non-current asset. Don't forget, PPE is a non-current asset. So PPE. Okay, so for 2022, we are going to use the closing revalued amount, which is 3,240,000. Okay, then 2023, the 2,880,000. We have it here. Okay, the carrying value. Where is it? Yeah, for 2023, this figure. Okay, and for 2024, it was sold. Okay, so 2024, there will be no asset, or there will be no non-current asset. That'll be dash. Then we have equity. Now, in the equity, we have revaluation surplus account. Okay, so with the revaluation surplus account, let me even bring retained earnings here because of the transfer. Now, with the revaluation surplus account for 2022, we had 540,000 here. Okay, then it would have been 540 again in 2023 and 540 again in 2024. But because of the transfer in 2023, we transferred 60 from the revaluation surplus account to retained earnings. Are you following? So it will be the 540 minus what? 60. Are you following? 540 minus what? 60. And that gives us what? 480. So there will be a balance of 480,000 in the revaluation surplus account in 2020 what? Or that's 2020 what? 3. Then 2024, there's another 60 transfer from revaluation surplus account to retained earnings. So the 480,000 minus 60, and that'll be what? 420,000. Are you following? So we transferred 60 in 2023 and another 60 in 2024. So this how it will be. Then the transfers, you come and add it to retained earnings. So this is retained earnings here will be 60,000. Okay. And then 2024, it will be the 60,000 plus another 60,000. So it will be 120. Because in 2023, the retained earnings, we transferred 60 from value surplus account to retained earnings. So in 2023, okay, the retained earning was 60,000. In 2024, we transferred another 60, okay, from value surplus account to retained earnings. So we'll add it to the previous 60 in the retained earnings, making what? 120. So this is when you sum, okay, the total equity, it will still be what? 540 here. Here will still be what? 540. And here will still be what? 540. You see? So the transfers the transfer is between equity items. It's between two equity items. Value surplus account and retained earnings. So you see the net will be the same. I hope you are following. All right. So this is how it will be. The transfers should be less from the value surplus account. Okay. So you have to use the transfer to reduce the value surplus account. So we transfer from the surplus account to retained earnings. So we have to reduce the surplus account and then go and add it to what? Retained earnings. Now you realize that as at 2024, when the asset was disposed, there's a balance of 420,000 in the value surplus account. There's a balance of 420. That 420 balance, okay, can be transferred to what? Retained earnings on disposal. That's the second transfer. We said if there's any balance inside the value surplus account and the asset is sold, the entity has an option. The entity is required, or let me say the entity can, but they are not mandated. They can. Okay, so it's not mandated. They can transfer the balance. So in that case, all this 420,000 can be transferred to what? Retained earnings. We can transfer it and come and add it to what? Retained earnings. But this is an option. Don't forget that provision. All right. Okay. Let's look at. So that's it with question 5. That's it with question 5. So question 6. CN Limited revalued its land and building at the start of 2023 to 4 million. That's 1,600,000 for land. The property cost 2,400,000 for land, 10 years prior to the revaluation. The total expected useful life of 50 years is unchanged. The company's policy is to make an annual transfer of realized amount to retained earnings required. Show the effect of the above on the financial statement for the year ended 31 December 2023. So here to be very simple. The easiest way is we split them. So we work with the land first. Land. The cost of the land, it's here. The property cost what? 2 million. But 400 is for land. So the cost of the land is 400,000. Then it was revalued at the start of the what? 2023. And what you have to know is that we said land is not depreciated. Okay, so we don't depreciate it. So we just compare straight. We compare the cost to what? The revalued amount. And we record our loss or gain. The cost becomes the carrying what? Value. So we have the cost, the revalued amount. And the revalued amount is 1,600,000. Why it's here? It was revalued to 4 million. But out of 4 million, 1,600,000 of the revalued amount is for land. Okay. All right. And then the remaining will be for what? Building. So if you find the difference, you will realize that we have 1,200,000. And this revaluation gain. All right. Okay. So that's all with the land. We are done. Then let's look at the building. With the building, the cost of the building is, so what is the total cost? The total cost is what? 2 million. But 400 is for what? The total cost is 2 million, but 400 is for 400,000 is for land. So the remaining will be for building. So the cost of the building will be 2 million minus 400,000. And that will be 1,600,000. So this is the cost of what? The building. Then we need to charge depreciation. Don't forget, you have to charge depreciation for what? 10 years. Because they said the property cost what? 2 million. 10 years here prior to what? The revaluation. So it means they purchased the asset 10 years before the revaluation. All right. So we have to charge depreciation for what? 10 years. So accumulated depreciation will be equal to the 1,600,000 over the useful life of the asset is 50 years. Say the total expected useful life. So it was 50 years. And we have to charge depreciation for 10 years so that we can get the carrying value. Okay, so it's 1,600,000 divided by 50 times 10. And that gives us 320,000. So the carrying value as at the time of the revaluation will be the 1,600,000 cost minus 320,000. And that will give us 1,280,000. So this is a revalued amount. Sorry, this is a current value. This is a current value. Then we compare with the revalued amount. So the revalued amount, we're told that the building was revalued at the start, okay, for 4 million. And 1 million is for what? Land. So the remaining, so 4 million minus the 1,600,000, which is what? 2,400,000 is the revalued amount of the building. Okay, so we have total revalued amount of 4 million. Out of this total revalued amount of 4 million, 1,600,000 is for land. So the 1,600,000 that's for land, take it away, and then the 2,400,000 is for what? The revalued amount for building. So let's compare this again, because carrying value is 1,280,000. Revalued amount is 2,400,000. So we have a gain of 112,000. Okay, so this is the revaluation gain. Okay, now let's continue. we were told that they make, okay, transfer. They do transfers. They do transfers. So let's not forget that they do transfers. So we are saying is that, what we are saying is that, okay, if the asset is revalued at the start of 2023, okay, then we have to charge depreciation for 2023. Don't forget that we have to charge depreciation for what? 2023. Because the valuation happened at the beginning. So what it means is that what it means is that the revalued amount of 2,400,000 for the building is as at the beginning, because the valuation happened at the beginning. Let's not forget that. So this revalued amount is as at the beginning of 2023. That's what the question said. They said valuation happened at the start of the year. So now we have to come and charge depreciation for 2023. And that will be the revalued amount now, the 2,400,000 over the remaining life. Now it was 50 years. We charge depreciation for what? 10 years. Okay, and it's a whole year, the whole of 2023. So this is how it will be. All right. So we pick the revalued amount divided by the remaining useful life. Okay, we said when we revalue an asset and we want to charge depreciation subsequently, then the revalued amount becomes what? The value for the value we are going to use to charge depreciation. Okay, we are going to charge depreciation using the revalued amount, not the previous cost or not the previous carrying value. Okay, so this will give us 60,000. Okay, so you realize that the carrying value as at 31st 12 2023 will be the 2,400,000 minus 60,000, and that will give us 2,340,000. So this is the carrying value as at the year end, and this depreciation that we are going to record in what? The P&L account. Now we said the question said they make transfers. Now if they make a transfer from revalued surplus account to retained earnings, then we said the amount of the transfer will be equal to the excess depreciation. That is depreciation with revaluation and depreciation without what? Revaluation. So this 60,000 here is the depreciation, okay, with the revaluation, the 60,000. That's the annual depreciation with the revaluation. Now let's see, without the revaluation, now what would have been the depreciation? Depreciation would have been on the old cost. Okay, so depreciation would have been on what? The old cost. Are you following? It would have been on the old cost. And the old cost is what? 1,600,000. Don't forget that. That's the original cost of the property. Okay, that's what we use here, the 1,600,000 over 50. All right. So it would have been 1,600,000, then 60, and it's a whole year. All right. So depreciation would have been what? 32,000. That's the annual depreciation. So without the revaluation, okay, without the revaluation, annual depreciation would have been what? 32,000. Where would have been the cost of the building, which is what? 1,600,000 divided by 50, and depreciation is what? 32,000. But with the revaluation, see what we are getting. We are using the revalued amount now, the 2,400,000 divided by the remaining life, 40, and we are getting 60. So can you see the difference? So the excess depreciation, which is equal to the 60,000 depreciation minus the 32,000 what? Depreciation. And this gives us what? 28,000 depreciation. So 28,000 is the excess depreciation as a result of what? We doing the revaluation. So here, what you can do is that, okay, we are going to debit revalued surplus account, and we'll credit what? Retained earnings. Okay, with the 28,000, meaning we are transferring 28,000 from the revalued surplus account to retained earnings. Then let's look at the extract. So this is how the extract will be. to the extra. Let's look at the P or L. So in the P and L, we are going to record depreciation for 2023. And don't forget this for 2023. So depreciation for 2023 is the 60,000. Don't forget, it's not the 32. The 32,000 is depreciation without evaluation, which was long ago. In 2023, that asset was revalued at the beginning of 2023. Okay. So if you want to charge depreciation for 2023, they have to use the revalued amount. You have to use the revalued amount. So that's what we use, the 2,400,000. And that's what gave us depreciation of 60,000. That's what gave us depreciation of what? 60,000. That's the depreciation we are going to record for 2023. Then we also have to record so let's look at other comprehensive income. Other comprehensive income, we are going to record revaluation gain. Now, if you check the gain on the where is it? So the gain on the land, where is the land? Yes, the gain on the land is what? 1,200,000, which is here. And then the building, the gain was what? 1 million. So this is the revaluation gain of 1,120,000. So these are the two gains. So we just put them together. So 1,200,000 plus 1,120,000. 1,120,000. 1,120,000. So when you sum the two, then we are going to get 2,320,000. So that's it. Then if you go to the statement of financial position, if you go to the statement of financial position, we have asset. Now the PP figure, okay, will be the current value here. I don't know if you've done the current value. Yeah, we've done it here. This one. Okay, so that's what we are going to record as the current value. For this will be the current value for no, let me check where's the current value. Where's the current value? Yeah, so this is the current value for the building. Okay, this is the current value for the building, and then the land, the current value is the 1,600,000. The 1,600,000. So we just sum the two. So we realize that the current value will be land and building. So building is okay. Land is 1 million. Let's start with land. Land is 1,600,000. Building is 2,340,000, and that will give us 3,940,000. Okay, all right. Then we have, so that's the asset. That's PP, non-current asset. Don't forget. Then we have equity. Our equity will be, we have revaluation surplus, and the revaluation surplus will be, now check something. We had a revaluation gain of, what's the revaluation gain? We had a gain here for land and building. So that's what we have in OCI here. These two. Let me change the pen color so that you see. This one. This is the total evaluation. But we have to less the transfer. Let's not forget that. So it will be 2,320,000. This is the total evaluation gain. Minus the transfer. Okay, the 28,000 transfer that we transfer from the revaluation surplus account to retained earnings. Let's not forget that. You have to less that one from what? You have to less the transfer, the excess depreciation. Okay, we have to less it from the revaluation surplus account, and the balance is what we are going to record. Don't forget, we said Revalued surplus account deals with what? Balances. Okay. So when you deduct the transfer that we are transferring, or the amount you are transferring to retained earnings, when you take it away from the revalued surplus account, the balance is what we are going to record here. Then if you go to retained earnings, we can have retained earnings here. Now the retained earnings is the 28,000, because we are moving it from revalued surplus account to retained earnings. And that's how it will be. All right. Now, if you go to question 5 that we solved, okay, let me show you something. With the question 5 that we solved, okay, now when you get to the, if you append the extract, okay, you can equally add your profit on disposal here. It doesn't matter. So, we made a profit of disposal, profit on disposal of how much? Gain on disposal, the 1,080,000. Okay. To the 1,080,000, you can bring it to the last year here. 1,080,000. So you can bring it here 1,000,000 and what? 80,000. You can record it in the P&L account in the last year. Okay. So the profit on disposal should be taken to P&L. All right. So let's not forget that. Let's not forget that. All right. So guys, it's fine. Let's end here. We'll still continue. Okay. Yes, we have solved question 6. Now we'll be left with the rest. We will solve all the questions. All right. So let's end here and continue in the next video. So I'll see you in the next video where we solve the remaining questions. Bye bye.